By now, you might be asking, Bianca, isn't reconciliation kind of a part of the accounting cycle we started with? All these types seem like an extension of that. What's going on? I hear you, and you're not wrong. The last step in the accounting cycle we covered was close your books. Closing the books out is definitely a type of reconciliation. You're ensuring all transactions and cash flow have been accounted for on the trial balance, and the journal and ledger are ready for the next month, right? As any bookkeeping boss will tell you, closing the books monthly is the gold standard for maintaining your accounts. Here's the subtle difference between a monthly closeout and other reconciliation types. When they're done. Not every account is closed out each month. In a large company, some accounts are only estimated at month's end, and then the full reconciliation process happens quarterly or annually. Eventually, all those estimates have to be reconciled to ensure financials are correct. As a bookkeeper, you will be reconciling accounts perpetually as a part of monthly close, quarterly reporting, and annual filing. Hey, that's job security, baby. And while software can be your best friend here, you need to understand how the process works. Let's take a moment to hear from a colleague with more insight into this whole reconciliation thing before we dig into the play-by-play.
Reconciliation is so important, and here's why. We can enter any transaction into a financial software or as a journal entry. We can enter whatever we want. However, if it doesn't clear the bank or clear a credit card or clear a loan statement, it didn't really happen. So the point of reconciliation is tying the transactions that have been coded into the books to an outside document that we have no control over. It's usually a financial institution issues a statement monthly or something like that. So we're tying our work to an outside document so the two entities are basically verifying each other. So most people or most bookkeepers are responsible for reconciling cash accounts like bank, like checking, savings, money markets, things like that. Anything you get a statement from the financial institution. Also credit cards, those come through. We would post all those credit card transactions and then double check that the balance at the end of each statement matches what the credit card statement says. There would be some other things that you would probably be reconciling every month if there's a loan with an amortization schedule and things like that. Those are typical things that bookkeepers would reconcile. However, there may be other sorts of accounts that will appear on a balance sheet that can be reconciled that we may not have the responsibility to do that. There might be something like stock trades or other investments like that. And just other things that the accountant might just be adjusting at the end of the year. So that is where a good conversation with the CPA or whoever their accountant is and the bookkeeper, it's just great to have that that relationship and you guys work as a team. So let the CPA or the accountant tell you what you should be reconciling monthly, and then there might be some other things that they do annually or quarterly or something like that.